Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Sara Naison-Tarajano, Global Head, Goldman Sachs, Apex, and Private Wealth Management Capital Markets, to discuss the secular growth themes that family offices are most interested in today. Sara, it's great to have you with us. Welcome to Trade Talks.
Pleasure to be here. Thanks so much for having me.
You got it. What are you hearing from family offices regarding risk in their portfolios, and how is that translating to their allocation in public equities?
Yeah, it's a great question. I'll start by saying, one of the really interesting things about this survey is we have our data from 2021 to look back at. It's the second time we've done this. What we see is that actually the allocations haven't changed that much. Family offices have outside allocations to alternatives at 44%, and they actually have a 28% allocation to equities. But what I think is most interesting in the approach is that almost half of families say that they plan to allocate more to equities in the next 12 months, and only 10% say they plan to decrease. And I think what that shows is that these family offices are ready to act on dislocations. They're not overly levered, and they have a long-term approach to the market. And so they use periods of volatility to think about how to actually create more exposure to asset classes that they like.
Family offices are also incredibly opportunistic. What secular growth themes are family offices most interested in today?
Yeah, by far the two most popular based on this survey that we put out is information technology and healthcare. And I don't think that's surprising. Family offices like to be at the forefront of innovation. Both of those areas are areas where really innovation affects how we live and work. Particularly with information technology, we've seen a lot of wealth created over exposure to information technology over the last 2 decades. When it comes to healthcare, I think there's another aspect at play here. Family offices, they're made up of individuals, and it's very hard to find an individual that hasn't been affected by disease, chronic disease, particularly coming out of COVID, where innovation in healthcare was sort of paramount till the economy functioning. And what I think is interesting about this outsized interest in healthcare is we see a convergence of family office philanthropic efforts coming together with their investing efforts. So you might see a family donating to a hospital on a cancer treatment center, and at the same time investing in a company that's impacting how we detect and treat cancer.
What differences, if any, do you see in the appetite for different alternative asset classes? Does this vary based on family office size?
It's a great question. I would say the appetite for alternatives is very high across family offices, regardless of size. We see that 44% allocation to alternatives, but how they approach the investing is where size makes a bit of a difference. And so we see large family offices, for example, with a lot of infrastructure, investing on their own, actually sitting directly on the capital table of companies, whereas maybe a smaller family office will do so more through an experienced manager. But what I think is interesting is that most families do have a little bit of a hybrid approach where they may pick the sectors that they know well to invest directly and use managers and outside experts in areas where they have less core expertise, something like biotech or even private credit, where we see families really focused on gaining exposure to private credit through expertise that managers have.
How are you advising clients amid today's uncertainty?
We're advising clients to stay calm. At the end of the day, our role in covering both family office and private clients is to help preserve and grow capital. Permanent loss is the biggest risk to that. So when you're a forced seller because you need liquidity, that creates permanent loss. Our advice is to stay invested. One of my favorite stats, you may have heard me say it before, if you look back from 2009 to today, you were out of the market. The 50 best trading days, you gave up 100% of the return of the equity market. Out of the market for 10 days, you gave up almost half the returns of the equity market. It is incredibly hard to time the market. So be confident in your asset allocation and use dislocations as ways to get additional exposures to areas that you really care about.
Sara, when does it make the most sense for families to set up a family office?
Yeah, this is a very personal decision, but we would advise a bit of caution. At the end of the day, setting up a family office involves a lot of infrastructure costs in people, potentially in space, in fees to set up the entities required. And so you've got to make sure that you've got a pool of capital that is large enough to create enough yield to really cover those costs. And we would advise families to go slow. I think one of the things that was most interesting from this survey, 70% of the families that we surveyed had over $1 billion, but the average size of the investment team was 5 people or less. So stay lean and stay nimble. You can always add resources later, but once you get into those fixed costs, it's very hard to pull back.
And finally, what's the significance of the family office practice for Goldman Sachs?
Yeah, it is a very important part of our coverage at Goldman Sachs. We have a global team. We have people all over the world. Family offices represent an increasingly important pool of capital. They're able to make investments across the capital stack of companies. They're being brought into deals alongside regular way institutional investors like pensions, endowments, hedge funds, growth equity managers, private equity firms. And we care a lot about these family offices, but we also care a lot about the people behind them, whatever their mission is, whether that's philanthropic, the mission of their family, the governance. And so that's something that we're going to stay in front of, and it'll remain paramount to our coverage in private wealth at Goldman Sachs.
All right, Sara, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill. I really enjoyed being here with you.